Hello and welcome to StockStrategyCircle.com. Today we're going to talk about 3 stocks, or ETFs rather, that maybe you should consider buying. They're worth taking a look at. Now, as part of the service, I went ahead and I created a watch list so you can have quick access to these stocks. And as you can see right here, we have new activity. Let's click on that. What happens is once I make the update, it will create the post, and then that'll throw you right into the watch list that I created for you. All of this happens automatically. All of these ETFs pay regular dividends that they create by generating income on the sale of options. From here, you go ahead and click JEPI, and this gives you a breakdown of the actual ETF. All the information you might want to know, the expense ratio. It has no underlying index. So what does that mean? Well, it selects stocks from the S&P 500. They identify value stocks that have favorable risk-return characteristics. After selecting and ranking the securities, they sell covered calls, which is basically a way to generate income for the fund on the stocks in the underlying index. JEPQ more or less does the same thing, except it does it with NASDAQs. If you want to follow up all of that, you can just follow the link. Everything you need to know is there. Let's take a look at the chart, though. Okay, there you go. Now, why should you consider these stocks? Well, first of all, as you can see, the market has been incredibly volatile. It's up, it's down, it's all over the place. The JP Morgan Equity Premium, that is so hard to say, JP Morgan Equity Premium Income ETF has consistently paid its monthly dividend, and the dividend is relatively high. So 35 cents a share, 39 cents a share, 42 cents a share, 30 cents a share, 30 cents a share, 34 cents a share, 32 cents a share. This last dividend was paid at 40 cents a share. So what does that mean? Well, it means that if you own 100 shares of it and you get 40 cents, that's 40 bucks. 40 bucks for doing nothing. So that's pretty cool. Now, currently, it does have a tendency in its value to follow the underlying market trend. So we had a nice little rally, the value went up. Now the market's kind of selling off, and it's starting to sell off. So what is exciting about this? What is most important to understand about this particular stock is that when it pays a dividend every month, if you set this up on a drip, which means you reinvest your dividends back into the underlying security, as the price goes up and you're buying 40 cents additional on every share every month, you get a smaller portion of shares, but you're still buying. Well, when the market falls down, the portion of the shares that you're able to buy with your dividend goes up. So what ends up happening is you dollar cost average in your original investment every 30 days. So no matter what happens with this stock, as long as they continue to pay a dividend, your holdings in it are going to go up every month if you reinvest the dividends. Now, if you're just looking for the income, okay, don't reinvest the dividends, and you're going to consistently get whatever it is they decide to pay. Now, prior results are no indication of future gains, but this is what the fund is designed to do. It's designed to create a monthly income based on doing covered call action. So technically, if I was trading this just as a stock, it kind of looks like maybe we're about to set up a test of this area right here. There was a lot of buying activity that went on in here. We have a spring on the chart right here, and it broke out, it went up, we're coming back down. Likely the value is going to fall on it here. But that means you're going to be able to reinvest using the dividends off your original money, even if the price of the ETF goes lower, and you can do it monthly. Let's take a look at JEPQ. Now, JEPQ is the more volatile of the two. This one tends to invest in the NASDAQ. But same thing. Every month they're paying a dividend, 55 cents this last month. 42 cents the previous, 42 cents the previous, 45 cents the previous. So that is relatively high monthly income for your investment in this equity. I mean, it would be very hard to even do that in real estate. I mean, it's almost better than being a landlord. And on top of that, you don't have any renters. JP Morgan's not going to call you in the middle of the night and say that their toilet is overflowed. Come plunge it out. It's just not going to happen. Now, this one is more volatile than the other because it tends to follow the NASDAQ. But again, the point of this is to get the dividend income. Now, so what does this show us that it's doing technically? Well, right now it's underneath the point of control. It has broken out to the downside. I would not be surprised at all to see this thing drop down here into the 48 price range. Probably hold up in there. Maybe it'll go lower. But if it goes lower, as long as they continue to pay the dividend and you drip it, you're going to be increasing your position all the time. Now, the RYLD, of all of these, it is the sleepiest. 16 cents, 16 cents, 16 cents, 16 cents. While this ETF is valued at $15.82, it's paying 1% a month. That's pretty fantastic. 1% a month. That's 12% a year just in the dividend. That doesn't have anything to do with what the underlying value of the actual equity might be doing. So think of it this way. At 1% a month, your underlying holdings are going to go up by 1% every month. So that's pretty sweet, right? So think of it like this. You buy 100 shares. That's $1,500. Next month, as long as they don't pass the dividend, you're going to get one free share. Well, it's not a free share. You're going to pay for it with your dividends, right? So at the end of the year, if you started off with 100 shares, assuming the price remains more or less equal to what the dividend is, you're going to end up with 112 shares. And that's pretty cool. And that is going to help compounding returns, which Einstein said really is the most fascinating thing about math. Now, past performance is not indicative of future gains, but the RYLD more or less traces the Russell 2000. And so the Russell 2000 is just not as volatile index as the NASDAQ or, in this case, the S&P 500. But why are we doing this? Well, number one, we want to park money in the market. And number two, we want to create some income. And number three, why not? I mean, it's a pretty good deal. I mean, this is way better than real estate in my view. It's more liquid. You can sell it almost immediately. The income is more consistent. And you're not going to get hit a bill to replace a roof. So, in conclusion, the 3 dividend ETFs that you really ought to consider getting a position in: JEPI, JEPQ, RYLD. This is Painless Trader for Stock Strategy Circle.